Welcome to our Research and Development Tax Credit for Software Development webinar. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. I will now introduce our speakers. Paul McVoy is a director for KBKG's tax credit consulting practice. In this role, Paul devotes his time to consulting companies in maximizing their R&D tax credit claims. Prior to joining KBKG, Paul was a manager at a Big Four accounting firm out of Philadelphia, San Diego, and Los Angeles offices. Paul has spent more than 10 years in public accounting, leveraging previous tax compliance and tax revision work experience to provide focused and thoughtful advice regarding the research and experimentation activities of his clients. Michael Maroney is a senior manager with KBKG and advises clients on tax matters related to federal and state research and development tax incentives. He has 20 years of experience working on tax reviews ranging from sophisticated multi-year claims to short-term consulting projects. He has advised hundreds of clients across a variety of industries, including aerospace and defense, manufacturing, agriculture, pharmaceutical, communications, industrial products, consumer goods, software technology, and energy. I will now turn the presentation over to our speakers.
Thank you, Myra. And can I just get a sound check? Can you hear me?
Yeah, you sound good.
Okay, terrific. Well, welcome everybody, and good afternoon. Welcome to our webinar. Just as a plug here, we do provide webinars at least once a month on the R&D credit. So if you enjoyed what you're hearing, please come back and sign up for another one of our webinars. So right now, here's the agenda of the items we're going to cover on this webinar. We're going to start with an overview of the software industry. Then we'll provide an overview of the R&D credit, the R&D tax credit, and how to maximize the incentive's value. And then we'll wrap up by discussing other considerations when claiming the research credit. Finally, I would encourage you to submit your questions, any that you have, in the chat box, and we will answer as many as we can, most likely during when the polling questions are launched. So let's go ahead and get started. So here's just an overview of the software development. You know, as you can imagine, there are just a ton of areas where software development takes place. This is not an all-inclusive list, but I just wanted to bring some of these to your attention. Of course, there's web development when you're talking about a website and e-commerce. There's mobile development, which is huge now. It seems like everyone out there has a mobile app, which is an abbreviated version of their full online website. And then there's data science, the analysis of a ton of information, and how to make sense of all of this to provide additional functionality and meaning behind all of the data. Usually that involves doing some trending and some analysis. There's application development, back-end development, any types of software tools that software developers use in order to program. Then there's embedded systems development. So if you have software that's going into a larger system, and that has to work together and be tested to ensure the proper function and features. Then there's cloud computing and security, and then finally video game development. So when you're thinking in terms of your clients and what type of software development they do, if you have clients that are involved with any of these types of activities, they are doing qualified research eligible for the R&D credit. So let's do just a quick overview of the typical software industry development life cycle. So there are 5 major aspects to this, and this is not mine. I've borrowed this from someone, so you can see the credit given in the bottom right-hand corner. But I thought this was really good. There's a requirements analysis that is done. There's design, there's implementation, and then there's testing, and then there's this whole evolution of software. So we're once you think that it's complete and it's ready to be implemented or released, then that's when the next revision begins, as you start going through this all over again. So let's talk a little bit about each one of these. So the requirements analysis, it sometimes requires that individuals and teams from the client as well as from the service provider get very detailed and accurate requirements as to what the software is going to do. And sometimes this is the most critical aspect of the whole process, because if there's any communication gaps that arise in this phase, it can lead to a breakdown, it could lead to validation errors and numerous bugs in the software. Then there's the design phase, and in the design phase, I'm not going to go through all the different types of phases here, but suffice to say the design stage, this is where the functionality, the features are described in detail, the screen layouts, the business rules, and any process diagrams and other documentation. It's really kind of what makes the software function the way that it's supposed to, or that it's intended, and that the goals are achieved. And then the next area is in implementation, and this is where modular and subsystem programming code is accomplished. Unit testing might be done at this stage as well, as you're implementing the software to test to make sure that it's conducting what it's supposed to do. And then there's the testing stage. This is really the all-inclusive testing. Once you've developed the design the way you think it needs to be and you've implemented it, now you go through the testing and try to find out what it can do, what it can't do. There's a bunch of like defect testing, data set testing, integration testing, regression testing, and performance testing as well. And then finally, I spoke about the evolution. This is also known as operations and maintenance. So whenever you hear about software, being in the maintenance phase, this is where oftentimes small improvements are made to the software to address any bugs that are being experienced by the users of the software. And then, as I said, that usually starts this whole life cycle over again with addressing those issues, coming up with new features and functionality, and then releasing them in a future release or version. So I just wanted to provide you with, this is just a little case study here of an overview of the software industry data science software. So here we've got a Chicago-based software company that created a new data science platform used by data scientists and analysts and engineers to prototype, build, and deliver their data product. So this company had some qualified projects you see listed there on the right-hand side of your screen. They programmed code to optimize communication. They designed a system that enables customers to detect fraud with predictive analytics. And then they programmed applications so customers could import data using various modules, various data sets across multiple platforms. So in this example, the company started in 2010. It had 23 engineers, software engineers, employee wages of about $3.5 million. Of that, we have qualified wages, which means that they are doing qualified research of just over $2 million. The company pays regular tax. Because the company is has been around for more than 5 years and making money, the payroll tax credit, which we can talk about in a little bit, they're ineligible for that. So it ended up for 2017 a $200,000 federal credit, and then an additional to that $52,000 in state credit. So with these set of facts and the work that they were doing, they were eligible for almost a little over $250,000 in tax credits just from the R&D credit?
Now is a good time to get into the R&D tax credit overview. So the Section 41 credit for increasing research activities was originally enacted in 1981, and it was a temporary code section at that time and stayed as such until it was permanently extended as part of the 2015 PATH Act. So the Section 41 credit is a federal statute, but it's important to understand that most states offer some form of research credit which borrows from the federal statute. And although every year there's billions of dollars of research credits claimed, there's still billions of dollars which go unclaimed. And this is due to either taxpayers being unaware that this credit is available, to tax preparers or taxpayers being unaware of whether or not the credit can be used to offset tax, or they don't think they can use it because they don't generate any income tax liability. And we'll talk about some of the other benefits of the PATH Act implemented in 2015 on some later slides. But generally, the Section 41 credit, it represents 6 to 10% of the qualifying research expenditures. And as such, it's a dollar for dollar benefit or a reduction in the taxpayer's income tax liability. Pass-through entities such as S-corps and partnerships can also claim the credit. Benefits just happen to flow through to the individual shareholders on each shareholder's respective K-1s. So the R&D credit can be claimed for any years that are open under statute, and it's important to note that unused research credits can be carried forward up to 20 years, as well as carried back 1 year. So what we have on this slide is the general R&D tax credit overview, or the 4 requirements that are necessary to claim the R&D tax credit. And oftentimes when a reference is made to research and development, taxpayers think of test tubes and lab coats, but in reality, the R&D credit tests are much broader in application. And provided we meet these following tests, we have an opportunity to claim the tax credit. So the R&D tax credit is activity-based, meaning the activity that we're performing must meet these requirements. And if they do, we can take the expenses associated with those requirements, with those activities, and claim the R&D tax credit. So without further ado, the first requirement is the activity must be technological in nature. In other words, the project must fundamentally rely on one of the hard sciences, such as physical science, biological science, computer science, or engineering. And on the next slide, we will focus on the software development aspects of this. The second test is the permitted purpose test, meaning what is the objective behind the research? The objective must be to improve the functionality, the performance, the quality, or the reliability of a new or existing business component. The third test is called the elimination of uncertainty test, meaning at the outset of the initiative, was there any uncertainty related to the appropriate design of said business component or the capability or methodology for us to develop or improve that business component? Lastly is the process experimentation test, meaning, and this works in concert with the elimination of uncertainty test, but this requires that substantially all the activities must constitute a process of experimentation, which is defined as the evaluation of different alternatives to eliminate the technical uncertainty identified at the outset of the project. So, provided the activity that we're performing meets these 4 tests, we can claim the expenses associated with that activity towards the R&D tax credit. So on the next, excuse me. So on this slide, we have an overview of the internal use software final regulations. So on October 4th, 2016, the IRS issued final regulations which provided guidance on the qualification of internal use software for purposes of the research credit. And the final regulations addressed many of the comments received regarding during the proposed regulation process that were released in January 2015. This is a summary of the final regulations, but the definition of internal use software is software that is developed by or for the taxpayer primarily for use in general and administrative functions that facilitate or support the conduct of the taxpayer's trade or business. General and administrative functions are limited to financial management functions, human resource management functions, or support services. Whether the software is deemed internal use or not depends on the intent of the taxpayer and the facts and circumstances at the beginning of the development. The definition of software that is not for internal use is developed to be commercially sold, leased, licensed, or otherwise marketed to third parties. The software that is developed with the intention of allowing taxpayers to interact with third parties, or that allow third parties to initiate functions or review data on a taxpayer system, is also not considered developed for internal use. So a good example of this is if we send a package using FedEx and we're able to go on to FedEx website and look at where exactly our package is in the U.S. or in the world over to determine when it's going to arrive, that interaction between FedEx and the end user would deem this not internal use. So the next item we want to talk about here is connectivity software, and this is also referred to as bridging software, integration software, or middleware. And this allows multiple processes running on one or more machines to interact across a network. And this software should be specifically identified or categorized differently from other types of software. And whether it is considered internal use or not depends on the function of the software rather than the type of software. An important note that we wanted to touch on related to the final software regulations is the dual function software. Dual function software is general and administrative software that also allows that interaction with third parties. This designation of dual use allows the taxpayer to identify a subset of the software development which allows that interaction with the third parties, even though it was mostly intended for general and administrative functions. So this safe harbor allows the taxpayer to include 25% of the expenses of the dual function software improvement in computing the amount of taxpayer credit if those activities constituted qualified research. So just to clarify, the third party means any corporation, trade, or business other than a person that is not treated as a single taxpayer pursuant to Section 41F. So just make sure we wanted to go over that. So if it is deemed internal use software from a taxpayer standpoint, it can still qualify for research credit treatment, but it has to meet 3 additional tests. And they're called the high threshold of innovation tests. And that means the software must be innovative. If the development is or would have been successful, the result would have been a substantial or economically significant reduction in cost or improvement in other performance metrics. Basically, if we use those metrics to determine whether or not it was innovative, we would meet that test. The second test means there must be significant economic risk, meaning the taxpayer must commit substantial resources to that development. Due to the technical risk, there would be substantial uncertainty whether or not the taxpayer would recover the amount expensed in a reasonable period. And lastly, the software can't be commercially available. I mean, it can't be an off-the-shelf software that we're implementing and it just costs a ton to implement. So we can't claim credit for the implementation of that type of software. So just note that these final regulations were to be applied prospectively from October 4th, 2016, and that the IRS would not challenge any return positions that are consistent with the final regulations for any tax year that ends after January 20th, 2015, the date which the proposed regulations were issued.
All right, thanks, Paul. So this brings us to another case study here. This is on internal use software, just to drive the point home here. So a Salt Lake City-based company created a new billing system to replace its legacy system. The new system would automate several manual functions. Although it would have some client-facing features, it was primarily intended for internal use. The qualified projects included they programmed modules to allow improved customer and vendor access to data within the company's database. The note here is, since this new billing system was considered dual-use software, only the portion of the development dedicated to the client-facing features and functionality were captured as qualified expenses. So with that in mind, if you look over to the left, the data here is that the operation started in 2004. There are 4 software engineers. Employee wages company-wide were $4.6 million. However, the qualified wages because this was mostly internal use and non-qualified. The qualified wages were only $200,000. The company pays regular tax, and this led to a federal credit of $20,000 and an additional $20,000 in Utah state credit, for a total of $40,000 in credit. So let's continue with some of the qualified software activities here. So any type of activity that involves developing new or improved technologies, developing software architecture, establishing relationships between software modules for functionality, programming and testing any software source code. We talked about integration testing and regression testing on a previous slide. Developing feature enhancements. This is new features or functionality. Conducting analysis for new functional software, end requirements, domain, software elements, or scope analysis, and evaluating and establishing functional specifications. So all of this type of activity, so long as the intent is to create something new to your company or to improve an existing module or software, then it will qualify for the credit. So we've talked a little bit about what does qualify. Let's talk about what does not qualify. Most of these are directly right out of the regulations or from the audit technique guide surrounding software. But maintenance, just routine maintenance of existing software applications or products will not qualify. Doing simple software application configuration, reverse engineering, that applies across all industries, not just software development, but any reverse engineering activity does not qualify. Performing studies or activities to select vendor products, in other words, doing research on price or features or functionality from vendors in order to select the most appropriate one is not technological in nature. There's no uncertainty involved with that. Detecting flaws and bugs in software that's been released is not something that will qualify. One of the things I want to point out here is that when you talk to software developers and they use the word bug, that doesn't necessarily mean that it doesn't qualify. Most of the time it probably means it doesn't qualify. It was just a small thing they had to fix. But if this is prior to release, then this is all part of the research and development, the process of experimentation in designing the software. Once it's been released, however, if there are little bugs that they need to work and work the kinks out of, it becomes a judgment call as to how much effort and programming is required, whether that truly is a bug fix or if this is more of a revision to a feature or functionality. Modifying existing software to make use of new or existing standards or devices or to be compliant with another vendor's product or platform is not considered qualified research. Also, developing software that is substantially similar to existing software may not qualify either. Any type of upgrading to a newer version of a hardware or software or installing vendor fix releases is not qualified research. Also, rehosting or porting of an application to a new hardware or software platform will not qualify either. I won't go through all of these, but I did want to touch on a couple of these. When you talk about data cleansing and data consistency activities, typically that's involved in data migration when you're moving data from one system to another and checking to make sure everything ported accurately. that's not considered. It's more of a quality control issue, and not an R&D issue. Bundling existing individual software products into product suites is also a non-qualified activity. With that, I'm going to turn it over to Paul. He's going to talk about who can qualify for the credit.
Thank you, Michael. If you don't mind going back to the last slide, I wanted to mention something that you touched on. As previously, we went through the software development life cycle, but if you think about it, we generally have to go through requirement specification, design, coding, testing, and performance tuning. Eventually, we get the product release, maintenance, and bug fixing. But like Michael said, based on the results of any or all of these steps, the software development activity may need to repeat or iterate through one or more of the steps. For example, assume a product development lifecycle was in a testing phase, a new requirement came in that for competitive reasons had to be incorporated into the product before it could be released. Then the new requirement would then have to be designed into the product, which in turn could affect the existing design and coding of the software already written and tested. And whether or not we use the term a bug fix does not mean we can't qualify that activity and the expense associated with it for the research credit, just like Michael said. So I thought that was important. I just wanted to touch on that again. So, okay, so moving forward, we want to talk about who qualifies for the R&D credit. And any employee who is performing qualified activities will qualify for the R&D tax credit. But one thing people forget is that also includes one level removed, meaning anybody who's directly supervising research activities or directly supporting research activities will also qualify. We had a great question here in the chat box, whether or not any payments made to a third party to do development on our behalf, whether or not that would qualify. And the answer to that is yes. Yes, any payments made to third parties to do development on our behalf will qualify for the R&D tax credit, but it is subject to a 35% haircut. There are a couple of additional rules we need to meet, but generally speaking, any payments for development on our behalf will qualify for the R&D tax credit. And then, like Michael mentioned, I think in the first couple of slides, all the activities must be performed in the United States. So, again, I want to give you an example of somebody who's directly supervising an employee, but let's say we have an R&D, we're doing some R&D in the software development space, and at the end of every day, we have a scrum meeting that's an hour in length that talks about what we accomplished today, what we plan to accomplish tomorrow, what got in our way of accomplishing our goals today. And that occurs with the person who's doing the coding and their direct supervisor who's talking them through what they've accomplished, how they can accomplish more in the future. Not only would the person doing that coding qualify, but the person involved in that review would also qualify. Any technical review or design meetings, the people who are putting input during those or providing input during those meetings could also qualify as well. And then for direct support, if you think about, let's say we're doing some testing and analysis and we need to document the results of that testing and analysis, and we provide the information to an executive assistant who types that up or puts it into a report. Those types of activities also qualify as direct support. So those are common areas that are not included when we review some R&D studies, and we wanted to make sure we went over that. So moving forward, we just have a quick overview of what the qualified research expenditures are that are eligible for the research credit. So to the extent a project meets all four parts of the test under Section 41 that we discussed earlier, we're able to capture expenses associated with them towards the research credit. And generally, we'll see three types of expenses. These are wages for the people who are doing the research, directly supporting it or supervising it, and that'll generally be the W-2 Box 1 amount. But really, any wage or compensation that's paid that's subject to withholding is includable for research purposes. So if we exercise some stock options, we can claim the credit associated with those. Qualified supplies, which we don't see in the software development industry that much, but let's say we had to purchase different pieces of hardware as subcomponents to a larger system, there may be an opportunity to claim all of that hardware as a qualified supply. And what is a qualified supply? Well, basically qualified supplies are any items that are used or consumed in the research process while we're performing our development activities. It's a lot easier to think about when we're in a manufacturing space and we're developing a prototype. Any of the materials used in developing that prototype would qualify. For software development, again, it'd be hardware or things of that nature that we need to purchase in order to create a larger system. And lastly is qualified contract research. And we touched on this a few moments ago, but contract research represents 65% of any payments made to individuals doing research on our behalf. Lastly, anytime we are using testing environments, let's say we're using Amazon Web Services and we pay an additional amount monthly to reserve a space as our testing environment, we can claim a portion of those costs under the rent or lease of computers. We had another question in a chat box. The rental or lease of computers is an outdated section, which I don't think has occurred since the 70s at least. So this is a new application of that stipulation under the statute. The PATH Act, which was passed in 2015, made 3 very important changes to the R&D tax credit. First and foremost, the R&D credit was permanently extended, and it allowed taxpayers who usually took the credit to continue to do so without that uncertainty, and enabled clients who hadn't taken the credit previously to start doing so, knowing that it would be around going forward. The second large change is that the R&D credit can now be used to offset a portion of payroll taxes for qualified small businesses. And lastly, qualified businesses can now use the R&D tax credit to offset alternative minimum tax. So I wanted to take a moment to discuss these. So a question came in, hey, we're a startup company, this is an income tax credit. We don't generate any income tax because we're in losses. Why would we file for an R&D credit? And this is where the PATH Act came in. And for qualified small businesses that aren't in a position to pay income tax liability, it allows you to take the credit and offset the payroll tax that you're paying on a monthly basis. And to do so, what we need to do is file our income tax return, and when we're filling out our quarterly reconciliation or Form 941, state that we've taken the research credit, and what that results in is either a refund from the government for 50% of the eligible taxes, or to apply those taxes on a go-forward basis. And really what this boils down to is that startup companies who are trying to disrupt the industry or come up with something, a brand new business component or product or platform, for doing nothing different than they're already doing, can generate a quarterly cash payment right back into the pockets to be reinvested for more or future development. And then the other item that is really important is from alternative minimum tax purposes, we weren't able to use the R&D tax credit to offset that, but due to the PATH Act, tentative minimum tax is treated as zero, meaning we can take our R&D credit down way past what would have been due previously, and really reduce the amount of taxes owed. And this is going to be of importance to many flow-through or conduit entities. If we're operating as an S corp or an LLC, it's something that we want to think about, because people who were in an AMT position before had large tax bills. So if we're performing R&D, or like Michael said, we had a partner who's doing R&D for the company, the credit associated with that R&D can now be used to reduce our tax bill. So again, this is cash right back into the pocket, and it's something that we've seen a large increase in over the last couple of years. So with that, I think we're going to go through a couple of different case studies. And again, these aren't super detailed, but what they do represent is an item to look at and understand, well, with this level of spend, what type of credits would we be entitled to, and whether or not it makes sense to move forward with that. So on this slide, we have an example of how a payroll tax election can help a qualified small business. And in this example, a software developer began operations in 2016 and is developing a new gaming application. The company is a pre-revenue startup operating as an S corp and has 15 employees. They have 0 gross receipts. They have qualified wages at $2 million. And we would expect there to be about $200,000 of R&D credits. Their qualified payroll taxes is $125,000. So provided the company filed their tax return in March of 2019, the rules state that you can file for the payroll tax offset in the subsequent quarter to when your income tax is filed. So because the first quarter, March, is when the income tax was filed, we can now apply the credits to the payroll tax due in the second quarter of 2019, or due after June, or with the July filing of the Form 941. So previously, this client would not have been able to use any of the credits. They would have to carry forward all of it indefinitely. But now what they can do is take $125,000 and it's all set in the second quarter, and then they'll have a $75,000 credit carry forward to apply towards their payroll taxes in the third quarter, or in perpetuity until those payroll taxes are exhausted. So this is a really important change that came about with the PATH Act, and really it's a use it or lose it type change. We can only claim this credit for 5 years, and we can't have gross receipts over $5 million. And to get the credit, it needs to be filed on a timely return, meaning if we file for the R&D credit in March 2019, we don't make the payroll tax offset election, we can't go back and amend that return for that election. So it's something to keep in mind. If we have taxpayers or clients, or we are a taxpayer who's in a startup position, we can use the cash. We haven't filed our tax return yet, or we're going to be filing one in the future, to reach out and make sure we're claiming that payroll tax offset. So moving forward, we're going to have an R&D tax credit example in the gaming industry. I think Michael's going to talk about this. So Michael?
Sure. So an Atlanta-based software company created a new gaming software for the Pokemon video game series. The qualified projects include programming software to animate different gaming assets or characters. They designed and coded custom 3D graphics and animation and sound effects, designed a proprietary motion capture software for realistic game character animation, and also developed a game networking architecture for multiplayer online games. The company started in 2015, had 23 software engineers, employee wages were $1.4 million, qualified wages of $800,000. They pay regular tax. Because of the age of the company, though, there's a startup, they are eligible for the payroll tax credit. And in 2017, they paid both federal and Georgia state credit. They paid federal and Georgia state taxes, received credits totaling $134,000, and they were able to offset their payroll tax with the R&D credit. In the interest of time, I think I want to skip this case study, software as a service, and I'm going to talk a little bit about the AMT offset. So for tax years beginning in 2016, taxpayers in AMT are now able to use the research credits to offset their tax liability. So in this example, the taxpayer generated $331,000 in research credits. Their tax liability comprised of $188,000 of regular tax and $31,000 of AMT, which resulted in $219,000 of total tax liability. So when we apply the Section 38 rules, as well as the new rules surrounding the PATH Act, it now allows the taxpayer to offset $178,250 of tax liabilities. Again, prior to the PATH Act, this taxpayer would have had to carry their entire research credit forward. As a result of the new rules, now the taxpayer will offset a large chunk of their tax liability and carry forward the excess credits. And now I'm going to turn it over to Paul, who's going to talk about maximizing the value in the software industry for the R&D credit. Paul?
Thank you, Michael. So anytime we're talking about maximizing value, we want to understand what the credit is worth to the company. And again, anytime we're doing software development, a lot of times we see it with startups or more mature companies. So the first thing we want to do is understand who's performing R&D, and whether we're the taxpayer ourselves, or we are the tax preparers for companies that are doing software development. We want to understand the general activities of the individuals at each company, right? So if the company is developing mobile applications, or they're creating software for different hardware, or if they're they're providing software as a service, as an add-on to a platform like Salesforce, whatever it is. If we understand that there's software development occurring, or they're trying to generate business within that industry, we want to make sure we're claiming the R&D tax credit. And in order to claim it, we can look at some job descriptions. We can look at whether or not there's any third-party software that they're using to document the R&D that's being performed. And then the questions we want to ask is, okay, we know that there's 3 or 4 or 5 or however many people doing the software development. Is there anybody who's helping drive product strategy, or where we're going to go in the future of this software development? A lot of times we'll have a chief technical officer who might not be involved during the day-to-day, but they are involved in review meetings, who we can potentially claim the credit associated with their time. So the next thing is, if we're claiming any of these additional costs, is what type of documentation is available to claim those costs? If we're using a third-party software like Jira or UTrack, or any sort of project management software, Asana, things like that, we want to look at what's within those third-party softwares that can help us document and substantiate the credits claimed. So what we have here in the industry is different types of software development that you can refer to if, after this call, to see if there should be an R&D credit that we're claiming. But again, I think what's important is understanding the business, understanding how many employees that are involved with driving the product improvement or developing the product within the business, even if they're only loosely related, and then making sure you're having discussions with someone with an expertise in Section 41 and Section 174 and in the software development industry to ensure we're maximizing the total benefit of the credit. Again, if it's a startup company, we can take that credit and offset our payroll taxes, which are going to be due regardless of whether we ever sell the company or get into a position where gross receipts are earned. So we want to take advantage of the credit while we can. So on this,
okay.
I'm sorry, Michael.
That's okay. That's okay, Paul. So this is a financial services software case study. So we've got an Austin-based software company that develops software tools designed to help banks, loan offices, and investment firms perform job functions. So some of the qualified projects included programming code to create a new lending platform that allows lenders to access data easier, view and share loan data, and order services. They also designed a new compliance management software as part of this development. It's a company that was started in 2017 with 23 engineers. They've got employee wages of $1.5 million, half of which were qualified wages for the credit. They pay regular tax, but they are eligible for the payroll tax credit. So in 2017, $75,000 credit was claimed, and a Texas credit of $24,583. So a total of almost $100,000 combined credits, and they were able to offset their payroll tax with the credit. And in the interest of time, again, I want to skip this last case study. Now, this one I do want to touch on. I'll spend a minute on this one. Software and hardware, we've mentioned it a couple of times, where you may be able to. Let's walk through the example, and it should kind of explain itself here. But a Philadelphia-based company manufactures kiosks and ATMs for airports, shopping malls, convention centers. Its software engineers develop the software that goes inside the kiosks. So qualified projects include programming code to improve security through enhanced encryption. They develop proprietary software for the robotics equipment on the production line. And then they also programmed code to allow access to multiple applications without exiting the main dashboard. So what we have here is we have a manufacturer using software programmers within the same industry here. They're creating the software that makes the hardware work, and that's what software in hardware refers to. So we've got a 2008 a company started in 2008 with 8 engineers. Company-wide wages were $2.5 million, qualified wages of $1.3 million. They pay regular tax, but they are ineligible for the payroll tax credit because they've had revenue for longer than 5 years. But their federal credit was $135,000 and a Pennsylvania credit of $65,000. So a total of $200,000 in federal and state credits. However, they were unable to claim the credit against payroll tax.
So the next thing we wanted to talk about, we touched on it briefly, is maximizing the value again in the software industry. And we talked about the different types of development that would qualify on a previous slide, but really there's a lot of areas that tend to get missed when we look at different R&D credit studies that have been performed or people just aren't aware of. So we always like to work with CPAs or the clients themselves to make sure we're including everything that we're able to have a benefit or to derive a benefit from. So some of these things that are typically missed is contract research. Again, payments made to third parties, let's say to develop an application on our behalf, that is qualifiable, even if we don't have anyone personally spending 100% of their time doing R&D internally. Anybody who's outside of the core software development departments tend to be missed as well. But again, we can include people who are doing development as well as one level removed. So let's say we have a founder of a company who has an idea and really wants to drive what the product's going to look like or what the improvement is going to look like. Even though they're not directly doing the coding, they are a critical part of the design process, and we can include them. Bonuses, stock options, we want to think about. Anything that's subject to self-employment tax, guaranteed payments can be included. Internally funded software projects. We had a great question in the chat box related to a client of mine is developing an internal software platform that's primarily for personal use, but there is an idea of rolling it out to the public in the future. And again, at the outset of the project, if there could be the option of rolling it out to the public, we can include that for R&D credit purposes and might not have to meet those additional 3 tests. So again, just make sure we're covering all the bases. Talk to an expert to ensure we're claiming the credit that our company is entitled to. So moving forward, we have about 5 minutes left. We want to get into some other considerations, mostly audit considerations for a couple slides. We'll do our last polling question, then we'll get going.
Great, thanks, Paul. So we talked about internal use software. So just make sure that you are looking at what Paul said. If it is truly internal use G&A, then it may not. It has to meet a higher threshold of innovation tests. Those 3 additional tests. Funded research is always a big issue. So whether it's a customer coming to you with requirements, or you are contracting the software development out to a third party, you need to make sure that the taxpayer retains the financial risk in the development and retains rights to the technology that's being developed. So as long as they retain the risk and the rights, then the research is deemed non-funded, and the taxpayer is eligible to claim those costs. Also, we want to make sure that when you're owner operators, oftentimes the taxing authority will come in and audit and say, the owner can't possibly be hands-on R&D. And from our experience, especially in smaller startup firms, the owners are the operators. And so you want to build a case around that to substantiate those activities. Highly compensated employees is another area of concern under audit. Is the compensation that of a partner, for instance, is getting paid? Is that reasonable compensation given the partner's position and involvement in R&D? And then finally, contemporaneous documentation. We never want to create documentation after the fact to help support the R&D. The R&D documentation should be generated contemporaneous with the activities being conducted. So So as such, I've just put a little bit a slide together here showing in the software industry what types of documents would be most beneficial to support the qualified activities. And I'm not going to go through any of these individually. I just want to refer you to this and also encourage you to download the slides from our website just so you have them and you can refer to them as you're discussing this with your clients.